Okay, today we're going to talk about budgeting. And budgeting is not a difficult area. It's simply detailed. It's very detailed, it's very step by step, but it's very logical. And so if you kind of think through what are we trying to accomplish here, it really isn't that detailed. The simple problem with budgeting is there's a lot of budgets we have to wrestle with in accounting. Here's a personal budget, and many people keep personal budgets, and the concept is pretty straightforward. Money comes in each month, money goes out each month, and let's see if we have enough to cover our bills. Hopefully there's a little bit left over to have some fun, save a little bit of money. Okay, the average American spends about close to 1/3 on housing. You see transportation, and as gas prices go up, that number goes up obviously. Utilities, clothing, etc. And so this is kind of a good little chart for you to analyze your own personal circumstances, see where you fit in this thing. All right, talking about business. Budgeting involves establishing specific goals, executing plans to achieve the goals, and periodically comparing actual results with the goals. Okay, and again, this makes sense. It's very logical. We talked previously about the concepts of planning, directing, and controlling. Okay, and budgeting is a key part of this whole planning process. Okay, setting goals gives us guidance, helps to motivate employees. A lot of salespeople, you set goals, and they have to reach a little bit to achieve those bonuses, commissions, etc. Keeps them motivated. Directing is the day-to-day activity. This is what managers do on a day-to-day basis. I like to look at this, the analogy I make is, if you like football, before the game you have the pre-game show, what do the Lakers have to do to beat the Pistons or whatever, and they talk about what has to take place. Directing is the actual game. You see the coach making changes, evaluating what's going on, what works, what doesn't work on the field. Okay, and then when the game is over, we go back to the drawing board, find out if we lost, what do we do wrong, what do we need to improve on, what skills can we work on, etc. It's the same thing with budgeting. So planning, directing, and controlling helps us to set a goal and to work in an efficient, effective manner towards that goal, to make changes as the environment introduces changes. If things aren't working, go to a plan B, see how we integrate it into our plan, and at the end of the year we compare budget to actual results and we see what happened. Okay? And within companies you have multiple responsibility centers. Okay? So if anything is a cost center, a profit center, investment center, these are concepts we'll see in a later chapter, then we assign responsibility and accountability, and if things go well, we know who to pat on the back. If things don't go well, we look to them to see how can we fix whatever shortcomings there were, how do we make it better. Okay? It's always about efficiency. Efficiency equals profitability a lot of times in business, providing you don't impair effectiveness. Okay? So we pretty much mentioned these concepts here. Feedback is a key part of controlling. Okay? Here's what we thought was going to happen. Here's what actually happened. Did we do better? Did we do worse? If so, why? Even if we did better, we still want to know why, and then we're going to modify next year's budget accordingly. Okay? Now, there are human aspects to budgeting, and these are important for managers to recognize because they can end up being counterproductive. Okay? If we set the goals too high, too difficult to achieve, then the workforce thinks, well, there's no way I'm going to accomplish this, so I'm just going to do business as usual. I'm going to work the way I normally do. And you have a dejected workforce like this poor guy underneath the bar there. All right? And so if you know, for example, you could offer me $1 million if I could dunk a basketball in a 10-foot hoop, I wouldn't move an inch because I know it's not going to happen unless I have a ladder. Okay? It's simply not going to happen, not at this point in my life. All right? Now, if you set the bar too low, you encourage bad habits. People tend to slow down. Once you achieve a budget, or if you see you're going to equally get that budget, you're afraid that if you blow past that budget too much, they're going to elevate that budget, which they should, of course. But for some people, that causes them to slow down and not work as hard, or the old use it or lose it philosophy. Okay, if you have money that you've been budgeted for your department, even if you don't need it, people will end up spending it. Otherwise, you're going to lose it next time. They'll say, "Oh, well, you didn't need it, so we're going to reroute it somewhere else where we can put it to better use," which is appropriate. But human nature being what it is, and you know, this school is a perfect example of this. When you get money allotted to you, you spend it, or else someone else is going to use it. Okay, and so these are issues that can arise when the budget has imperfections in it. Okay, and so a lot of times departments, businesses, etc., or will pad the budget, meaning they'll say we need more than we actually do because they're expecting their budget to get trimmed. And so if you start higher and they trim it down, if you do it properly, and I don't know about the word properly there, but you end up achieving what you wanted to in the first place. So these are just issues relating to human nature in the budgeting process. Additionally, you can have something called goal conflict. And this is when a department's or an individual's goals are in conflict with the company's overall goals. And so companies have to be sensitive to this concept. A couple of examples. If you pay bonuses to the salespeople in your sales department based purely on sales, okay, they're not going to be mindful of who they're selling to. And so if they're allowed to extend credit to anyone, their goal is to generate sales, to report revenue. Remember debit accounts receivable, credit sales? Well, the problem is that receivable has to get collected. And that puts them in conflict with the credit and collections department. Their job is to make sure we turn that into cash, or else we just gave the product away. And so you can have a conflict between departments. Same thing if you slash the tech support's phone budget. Okay, their job is to keep customers happy when we run into tech problems. Okay, and we've all experienced the frustration of when technology doesn't do what we want it to do. It drives us crazy. So we call tech support, but if they're going to get dinged for spending too much time on the phone, then it's going to encourage them to be short with their customers, who in turn will get frustrated, and the company's reputation suffers. Okay, so companies have to be mindful of the potential for goal conflict. So some of the human aspects of budgeting. Okay, when we talk about budgeting, it's typically for a one-year period. And there's a couple of different approaches we can use. The first one we'll look at is called continuous budgeting, and we're going to talk in general terms here. Continuous budgeting basically says, okay, here's what we did for the last 12 months. Let's look at what we did a year ago, and we'll modify it if necessary, but we'll use that as our starting point. Okay, so there's February of last year. A year from now, we'll look back at this past February and say, okay, do we think anything's going to be different? Let's go ahead and use that as our starting point, and we can modify or tweak it as necessary. Okay, that's continuous budgeting. Just keeps rolling forward. Okay, now, some companies will go to what's called zero-based budgeting. This is a more time-consuming process, but the argument in favor of zero-based budgeting is it causes you to take a fresh look and not rely on other people's thought processes in the past. So you're starting from scratch with zero-based budgeting. Clearly, it's going to be more time-consuming, okay? But it may result in a more appropriate, fresher look at how the budget process should take place. So there are pros and cons to continuous budgeting, zero-based budgeting, and these are terms you should be familiar with. Okay? Additionally, we're going to look at a static budget versus a flexible budget. Now, a static budget simply means we say, all right, we anticipate we're going to sell 1 million units, and we're going to produce cost budgets based on 1 million units. Okay? Static means it stays put. It doesn't change. It doesn't move. So if we sell 900,000 units or 1.2 million units, then when we're comparing actual to budget, we're comparing two different production levels. So a static budget conceptually is not a sound way. It's too rigid to budget. Instead, we want to use what's called a flexible budget. Okay, and we can anticipate at the beginning of the budgeting process how many units we think we're going to sell or produce. But we can also say if we sell 10,000, 20,000, 30,000, 40,000 units, this is what the cost should be. And so then we're in a position we can actually modify or flex the budget to say, okay, we anticipated originally selling 10,000 units, but we sold 13,000. Let's modify or flex the budget to say, given that we sold 13,000 units, let's see what the budget should have looked like at a level of 13,000 units. Then when we compare budget to actual, we have a fairer comparison than actual sales of 13 to the original budget of 10. We're going to take a look at an example of this. Okay? Now remember the concept of the relevant range. We talked about this in a previous lecture. We can build out flexible budgets at various different levels of activity within the relevant range, which is our normal expected production capacity. Okay, let's take a look at this example. Here's a static budget at the 10,000 unit level. Okay, and these numbers are simply given to us. Okay, so budgeted production in units, 10,000. This is overhead, so materials, labor, utilities, depreciation. This is what we budget the cost to be, total cost 1.1 million. Okay, now notice, we actually produced 12,000 units since demand exceeded what we expected. So that's a good thing, that's positive. And here's our actual costs to produce 12,000 units, but if I'm comparing it to the original static budget at 10,000, you can see that we went way over budget. Okay, and that U at the end there, that means unfavorable. Okay, and we don't like unfavorable in business. Okay, and so we're like, wow, very unfavorable budget. We really need to keep an eye on our costs, but obviously this is not a fair comparison. So a better idea is to modify the budget. Let you look at that on your own there. Total unfavorable variance 132. There we go. So what we can do is we think back to cost behavior in a previous lecture. We know variable costs vary in total, but remember, variable cost per unit stays the same on a per unit basis within the relevant range. If that doesn't sound familiar, go back and review the previous chapters. And we know that fixed costs in total stay the same. So as long as we are within the relevant range, fixed costs aren't going to change. But once we know the variable cost per unit, we can calculate variable costs, such as labor, materials, etc., at different levels of production. So here, given our original budget, we budgeted indirect materials 250,000 to produce 10,000 units. That's going to give us a variable cost per unit. And again, go back to those graphs we looked at in a previous lecture and review them conceptually. Make sure you understand them. So indirect materials have a variable cost per unit of $25. Indirect labor, 260 divided by 10,000 gives us 26. And utilities, 190,000 divided by 10,000 units, $19 per unit. Now look at the box below. We know that we produced 12,000 units. We budgeted 10, actually produced 12,000. Now that we have our variable cost per units, we can say, here's what our variable costs should have cost us, given that we produced 12,000 units. And now this we will compare to our actual costs at 12,000 units. That's a fairer comparison. Let's take a look. Okay, so now let's compare budget to actual, but notice we modified the budget to be the same as what we actually produced. This is what a flexible budget does. So now our budget says, given that we produced 12,000 units, what should it have cost us? Notice the fixed costs don't change. That's because their cost behavior, they are fixed in total. Well, as long as we're within the relevant range, they stay fixed. No change. But the variable costs will change. They vary. All right, so we calculated the variable cost per unit, and again, think back to those graphs. Variable cost per unit we assume is constant within the relevant range, but now we multiply it by the actual level of production of 12,000 units, gives us a much more meaningful comparison. And notice that the variances are very small, and in this case they're favorable, but even if they were unfavorable, they're manageable. Whereas the previous comparison, actual at 12,000 to static budget at 10,000, those unfavorable variances were large. And if I was a manager and I didn't know better, I'd be very concerned. Okay, but that, again, that wasn't a fair comparison. So here, we modify the budget, flexible budget, have a much better, more reliable, relevant comparison, and we can see that all systems like that they're brewing pretty well. Okay, a good manager knows when to leave things alone and where to pay attention to the problem areas. Management by exception. Okay. So, we've already talked about these. Let's just review the bullet points briefly. Okay, identify the activity index and relevant range. We talked about relevant range. Activity index would be production levels. What do we think we're going to produce? 10, 11, 12,000, etc. Identify variable costs and calculate variable cost per unit. Identify fixed costs. They don't change. Okay, and then modify the budget. As long as we're within relevant range, should be easy to do. And then we have a better comparison, fairer comparison. All right, when we budget, we have what's called operating budgets, financial budgets. It's typically for a one-year period, and you can break it down in increments of monthly or quarterly, all right, versus long-term capital budgeting, okay? Let's talk about an airline, United Airlines, American Airlines, whatever. They got to look way out into the future, typically 5, 10 years, and say, what's worldwide or domestic demand going to be for flying? Okay, and then buying a Boeing or an Airbus plane is not a cheap proposition. We're talking contracts in the billions of dollars. This is not something you casually budget a month or two in advance. You got to go way out because financing becomes very important. Okay, and you got to see how much of our own money will we put in, how much we have to borrow, how much can we borrow, what rate can we get. So long-term planning or capital budgeting typically goes out 5 years, sometimes more. Whereas the budgeting that we're talking about in this chapter is operational budgets, typically monthly, quarterly, and an annual budget. Okay, the starting point is what's called the master budget. All right? And as I mentioned just a moment ago, we have operational budgets, which are the budgets that will end up constructing the income statement, and then the financial budgets, which are our balance sheet, and our cash budgets. And we're going to look at some of these budgets. If you looked at the chapter in advance, you might have panicked because you saw at least 12 to 15 different budgets. I'm going to tell you which budgets I want you to focus on, and for testing purposes, you can rely on that. Okay? And so we have the master budget, which is all budgets combined. Everything collectively is the master budget. Okay, there's no one budget that says, oh, this is the master budget. It's simply every single we create collectively is the master budget. Okay, and here's a good diagram of the master budget. And notice it starts with the sales budget, and actually the sales budget is preceded by something called the sales forecast. From the sales budget, we have the production budget. Once we know how many units we're going to produce, how much materials, labor, and overhead do I need? What's my selling and admin budget for advertising, marketing purposes? Okay, that helps me build my income statement. And let's just think about this. Let's kind of put pieces together. We know that cost of goods sold is comprised of direct materials, direct labor, and overhead, right? And we know that our selling and admin are our operating expenses. And let's just think back to the multi-step income statement. Sales revenue minus cost of goods sold equals gross profit, minus my operating expenses, which is selling expense and administrative expense, equals operating income. Then below that, we have the other revenues and expenses and some of the more esoteric items at the bottom of an income statement. But our main business, our primary operations, consist of what makes up cost of goods sold and operating expenses. Okay? So there's our budgeted income statement. Below that, we'll have our cash budget, our balance sheet, etc. And then capital expenditures, that's for the 5-year planning. We'll talk about that towards the end of the semester. Now, the good news for you is that forecasting is a complex process. I mean, big companies hire people with PhDs in econometrics and all sorts of complicated degrees out there, and their goal is to look into the crystal ball and predict the future, and needless to say, that's a challenging prospect. Look at some of the things that have to be considered, and think automotive. Okay, we all are familiar with cars, most of us drive cars. Think about what Ford and GM and Toyota have to anticipate in order to reasonably accurately project how much they're going to sell, because an awful lot's riding on this. If they under budget, they're going to run out of inventory, they lose business, because people don't want to wait around too long for cars. If they over budget, they're going to get stuck with a mountain of very expensive inventory, and that's going to hurt cash flow. That can kill a company. General economic conditions, okay? Is the economy soft? Boy, I'll tell you, automotive gets beat up badly when the economy goes soft. People simply hold off. They drive that clunker a couple of more years, they maintain it a little more, and they simply make do. So automotive gets hit hard when the economy goes soft. Okay? Industry trends, technology. For me, it's got to have a cup holder inside or I'm not buying it. So they have to know what customers want in their cars. So they do a lot of market research, pump an awful lot of money into advertising. If you've ever watched TV, then you know that you see an awful lot of car ads out there. I think they say that the average person has to see a particular model at least 8 times before it registers in their head. So that's why they're always bombing us with TV commercials. Okay? Building on market share, price changes, technological developments, things like price of gas, miles per gallon, warranties, alternative methods of transportation. When gas starts going too high, people hop on the train. So there's an awful lot of stuff that companies have to build into the sales forecast, And once they have the sales forecast, then they can build the sales budget. And the sales budget is actually a very simple budget. Okay, so once you've done the forecast, and again, in this class, we don't worry about forecasts. It's beyond the scope of this class. But recognize the importance of a forecast. Once you have the forecast, the sales budget is very simple. Okay? You basically multiply the number of units you think you're going to sell times the sales price, and boom, there's your sales budget. Okay? So again, lousy forecast means meaningless sales budget and problems. Okay? So forecast is important, but you don't have to worry about it. It's the budgeting, the mechanical, the quantitative element that we're going to focus on here. Okay, here's a very simple sales budget. Now let's just take a look at the information because the details are important. Expected sales volume 3,000 units in the first quarter with a 500 unit increment increase for each quarter. Okay, so what that means is, well, the numbers are pretty self-explanatory. Each quarter we'll sell 500 units more. Let's keep it simple. We're just trying to convey a concept. Now, we anticipate selling each unit for $60 per unit. If you anticipate a sales increase, decrease, whatever, as you can see, it starts to get a little bit more detailed. But let's keep the concept simple. So you simply multiply the number of units to be sold times the sales price, and there's the budgeted and anticipated revenue per quarter and for the entire year. So you start with the sales budget because based on what we think we're going to sell, that'll help us determine how many units we have to produce, and from that, how much materials, labor, overhead we're going to need. Okay, so after the sales budget comes the production budget. Okay, now, things might get a little confusing here, so listen carefully. You in financial accounting learned that cost of goods sold was beginning inventory plus purchases equals cost of goods available for sale minus ending inventory equals cost of goods sold. The formula for the production budget is a little bit different. We're going to flip-flop things, but it makes sense if you think it through. If you just memorize it, then again, these things are not so meaningful. But if you think it through, it actually makes sense. We know how many units we're going to sell from the sales budget. Okay? Now notice, to that number, we're going to add what we call desired ending finished goods, or desired ending inventory. In other words, I don't want to be left with zero. I don't want to be utterly wiped out. I want to have some units on hand so I can get to a head start for the next quarter. Or in the event that demand is a little higher than we anticipate, I can handle it. Okay? I don't want to be cleared out of inventory because then I lose business. So we want to have some ending inventory at the end of the period. We call that desired ending inventory. Okay, so I need the number of units I'm going to sell plus how much inventory I want to end up with at the end of the year. That's my total needs for total units needed. Now, if I have some units in beginning inventory that have already been produced, that's my head start. I'm going to subtract that, and that leaves me with the actual number of units I have to produce. Okay, so sales units plus desired ending inventory minus beginning inventory, what I already have, equals required units to be produced. Okay? And if you think it through, it makes sense. Okay? Let's take a look. Now, and remember this, the production budget is in units. It's not a dollar amount. It's simply physical units to be produced. Now, also we need to know, and I would give you this information, what do we want to have in ending inventory? Okay, so I have to give you enough information for you to construct a budget, and you need to know what ending inventory, or a desired ending inventory, will be for the following period. Now, in this case, we want to have ending inventory that equals 20% of the following quarter's sales. So you go to the sales budget, and we see that this period, I'm going to produce 3,000 units. The following unit, I anticipate selling 3,500 units, and I want to have 20% of that, or 700 units, in ending inventory. So I need 3,700 units. I have beginning inventory of 600 units. Now, in the event I didn't give that to you, okay, you could have calculated that number because you could have said to yourself, all right, well, last quarter, if I'm looking forward to the first quarter of this year, and I know I'm going to sell 3,000 units, then last quarter, my ending inventory would have been 20% of that of 600 units. And if remember, last period's ending inventory equals this period's beginning inventory. The clock strikes midnight, ending becomes beginning, new time period. Okay? Or I'll simply give you beginning inventory, but you can calculate it. So if I already have 600 units in beginning inventory, then I need to produce 3,100 units. Now, hit pause if you need to. Think it through, because once you see it, you say, okay, this is a straightforward concept. And it is. Okay, so first quarter, I got to produce 3,100 units. Next quarter, I'm going to sell 3,500 units, I hope, anticipate. And I want to have a desired ending inventory, 20% of quarter three's sales of 4,000, so that's 800 units, 4,000 times 0.2. I need a total of 4,300. Notice how the first quarter's desired ending inventory becomes the second quarter's beginning inventory. Now that's our head start. We already have 700 units. I need to produce 3,600 units, and so forth. So on your own time, run these numbers and try to make sense out of them. Okay? Now, notice there's a little letter B, and we go to our little legend down here, and I would have to give you the following year's first quarter sales so you could determine ending inventory for the fourth quarter. Okay, so remember, I have to give you enough information that you can calculate the budget, providing you understand what to do. And they say that, I guess the trend will continue. We'll just say fifth quarter, which is really first quarter of the next year, 5,000 units, and 20% of that would be 1,000. So you can reconstruct these numbers. Total production for the year, just add up the 4 quarters, 15,400 units. Now that we know how much units we have to physically produce, in order to produce units, I need materials, I need labor, and I need overhead, right? The factory, the depreciation of machines, the energy, the utilities, etc. So our next budget is the direct materials budget. Okay, now, we need to calculate both the cost as well as the physical units that we're going to need for direct materials. So again, I have to give you some of the numbers, and notice that we want, actually it's the next slide, okay? I'll have to give you the cost per unit for materials, the number of units, it might be gallons, pounds, whatever the measurement is, and if it could be bags of powder, for example, or physical units or pounds, whatever it may be, and then there's a cost per unit, okay? And so notice that the formula here is similar, or the same actually, as the production budget. Direct materials units in physical units required for production, plus desired ending inventory minus beginning inventory, equals number of units that we have to purchase. Let's take a look. So in terms of physical units, calculating direct materials is the same as the production budget, same formula. Okay? But in addition, we now need a couple of more pieces of information. And again, I have to give you this information. Notice that in this particular example, we want ending inventory for materials, direct materials, to be 10% of next quarter's production, not the sales budget. Got to read the information carefully. We're going off the production budget on this case, okay? And each unit that we build requires 2 pounds of raw materials, and we currently pay, and maybe we have a contract, $4 per pound. Okay, so we're going to have a physical units calculation, and we're going to have a dollar amount for this budget. Let's take a look. All right. And remember what I said earlier. One of the nice things about managerial accounting is you can set up a budget, a spreadsheet, formulas, whatever, any number of different ways. There's no one format that you have to follow. This is a very clean, logical format, okay? But you can set it up in different ways. The important thing is you draw the right conclusions and the right calculations. Let's go ahead and see what they did here. And again, there's a couple of different ways we can do this. We'll simply work from this particular slide. Okay, so from the production budget, we know that we're going to produce 31, 36, 41 units each quarter. And we know that we need 2 pounds per unit. So we multiply each production requirement by 2. We need 6,200 pounds. Now let's calculate desired ending inventory. If you go back to the previous slide, actually we don't have to, it's right here. We want to have 10% of next quarter's production requirements. So in quarter 1, we're looking forward to quarter 2. I know I'm going to produce 3,600 units. Each unit requires 2 pounds. That's 72 or 7,200 units. 10% of that is 720 pounds. And here it is, line 9 in the first column. Okay, so I need desired ending inventory 720 pounds. So I need a total of 6,920 pounds. Now, beginning inventory, we can do the same thing we did for production. If I don't give you that actual number, we can say, all right, well, if I was in the fourth quarter of the previous year, I'd be looking forward 1 quarter to the first quarter, 3,100 units times 2 pounds per unit, 6,200 times 10%. That would be last period's desired ending inventory, which when the clock strikes midnight becomes this period's beginning inventory. So we already have 620 pounds. I need to go out and buy 6,300 pounds for the first quarter at a cost of $4 per pound. It's going to cost me $25,200. Let's look at the next quarter. I'll let you do the remaining 2 on your own. Period 2, I'm going to produce 3,600 units. Where did that come from? And you say the production budget. Each unit that I produce requires 2 pounds of material. That's 7,200 pounds. My desired ending inventory, I look to the third quarter, 4,100 units to be produced, 2 pounds per unit, that's 8,200. 10% of that desired ending inventory, 820 pounds. I need a grand total in the second quarter of 8,020 pounds. Last period's ending inventory becomes this period's beginning inventory. That's my head start. So I subtract that. I need to go out and buy 7,300 pounds at $4 per pound. Second quarter, 29,200. Okay? And so forth. We can see that for the year, I'm budgeting $124,800 for materials. So you can see how the budgeting process kind of cascades. Starts with forecast, sales budget, production budget, materials budget. We'll also do labor budget, overhead budget, etc. Okay. Speaking of the labor budget, this one's actually a little even more straightforward. Okay? So we need to know how much we pay our employees per hour, and we need to know how many hours they're going to work to produce X number of units. And again, we're going to work off the production budget. Okay? The production budget feeds the materials, labor, and overhead budgets. Okay? So, let's take a look. Units to be produced from the production budget times the direct labor time per unit, and I have to give you that number, times the hourly rate. And that'll be our labor cost. So when we plug in the numbers, we pay our employees $10 per hour, and notice it takes 2 hours of labor to produce 1 unit. Now, I might give that to you in minutes, and I might say it takes 1/4 of an hour per unit, so you'll have to do a little bit of modification, but the concept is very straightforward. Now again, look at the spreadsheet. From the production budget, we have 3,100 units. Each one requires 2 hours of direct labor. So in the first quarter, they're going to work 6,200 hours at a rate of $10 per hour, $62,000 of direct labor in the first quarter. So this is a very simple budget, very straightforward budget. Of course, if you're manufacturing a Boeing airplane, you're going to have a zillion of these things because you have lots of different departments and different hourly wages, etc. But the concept is straightforward. Total direct labor looks like $308,000 for the year. So we've already calculated the direct materials budget. We have the direct labor budget. Okay, now here's some good news for you. The overhead budget can be very, very detailed since there's going to be a lot of line items in an overhead budget. The good news there is I'm not going to test you on the overhead budget. It's in the book. You should look at it. Okay, but it's simply a little too cumbersome for class purposes. If I can have you do a sales budget, a production budget, materials budget, labor budget, I think I will have tested you on the concepts sufficiently. I could ask you a multiple choice question on an overhead budget, but I'm not actually have you produce an overhead budget. I could have you produce any of the budgets we've seen so far, so make note of that. Okay, so the last budget we're going to look at is the cash budget. And on the board, I'm going to create what's called a cash receipts budget. Recognize that there's also a cash disbursements budget, and we compare each month's money coming in, receipts, with each month's disbursements going out to see, are we going to have enough cash left over? And usually companies want a minimum balance in cash. And so if they project that they're going to fall below that minimum balance, then they want to have a line of credit lined up with the bank. And of course, they're going to have to pay interest on that money. Okay, so we're going to take a look at the cash receipts budget. And again, it's not difficult, but a lot of people mess this one up because they're not careful with their calculations. Let's take a look at the information on the board here. And as you can see, I'm going to work this on the board, and I've set up a little structure. And again, you can, with budgeting, it doesn't matter which are in the columns, which are in the rows, as long as the numbers make sense. Okay? This is how I set it up. Now, our company, so let's say, for example, it's a retail business. We have a lot of cash sales. About 30% of our total sales revenue is received in cash, right on the spot. And the other 70%, we extend credit. We run a credit check, and we extend credit. And for the credit sales, the 70% of our sales, which are credit sales, here's our collection history. 50% of the credit sales, not total sales, credit sales, are collected in the same month. So people who buy stuff in the beginning of the month, the middle of the month, pay us by the end of that month. 30% of my credit sales are paid the next month after the sale. 18% of my credit sales for any given month are collected 2 months later. And then notice, about 2 months are uncollectible. Excuse me, 2%, not 2 months. 2% of my total credit sales are uncollectible. Bad debt. You recall that from financial accounting. Now, notice I've given us total sales revenue figures for November, December, Jan, Feb, and March, and we are going to do a cash receipts budget for the first quarter, which is January, February, March. But because of my credit sales and my collection history, I need to go back to the previous year for November and December sales. And so let's build this budget. I need to refer to my sheet to save some time since I don't have a calculator with me. Now, first, let's drop the cash sales in, since we know cash sales are collected right on the spot. All right? Now, we got to do two things. November, cash sales were collected in November, so I'm not concerned because I'm doing a first quarter budget. Same thing with December. I need to look at the cash sales for January, February, and March. January, total revenue, after Christmas, people are wiped out, so sales drop, $75,000, and we know 30% of that is a cash sale. So I multiply 75,000 times 30%, and I get 22,500. Okay? So have a calculator in front of you. You should run these numbers as well. Let's just do the cash sales first. You don't have to. You can do it month by month. I'm just going to lay out the cash sales first. February, 120,000 total sales. 30% of that are cash sales. That's 36,000. And March, total sales 140,000. 30% of that is 42,000. Okay? There are my cash sales. Now, credit sales are a little trickier. I have to go back to November because 18% of the credit sales are collected 2 months later, and 2 months after November is January, which is in the first quarter. So, follow along here. November, total sales, 100,000. 70% of those are credit sales, so 70,000. And the portion of the credit sales from November that are actually collected, cash receipts in January, 2 months later, 18%, so $70,000 of November credit sales times 18% is 12,600. Okay? Hit pause, go back and reconstruct that number. Make sure you understand it, because once you see the process, it's manageable. Okay? Again, for November credit sales, again, the objective here is my first quarter cash receipts budget. 2 months later, 18% of November credit sales are collected in January, and that's part of my first quarter. So, again, 100,000, 70% credit sales is 70,000. 70,000 times 18%, 12,600 November credit sales collected in January. Let's do the same thing for the month of December. So first, 250,000. I have to multiply that times 0.7, and that's going to give us, I want to say, 175. But again, do it on your calculator, figure it out. And then For the credit sales of December, 175, 30% are collected in the following month, which is January, and 18% of December credit sales are collected 2 months later, which is February. So credit sales for December, 175 times 30%, 52,500 are collected in January, and then 18%, or 31,500, of December credit sales collected in February. Okay, now we're into the actual month sales. We've already, of January, February, March that is, we've already recorded the cash sales. Let's do the credit sales for January. 75,000 times 0.7 gives us, I want to say 52,500 times 50% are collected in the same month. So half of my credit sales, or 26,250, will be collected in January. 30% of the January credit sales are collected in February. That's 15,750. And 18% are collected 2 months later in March, 9450. Okay, and again, run these numbers on your own at your own pace. February, 120 times 70% credit sales is 84,000. Half of February's credit sales will be collected in February. That's 42,000. And 18% of 84,000 will be collected in March. That's 25,200. Okay, and then last, March, 140,000, 70% credit sales is 98,000, and half of those are collected in the same month, which is 49,000. Okay, now, if I'm doing a computer program, it's going to lay out April, May, June, etc., but I just wanted the first quarter's cash receipts, and now we have them. So let's just simply add up the numbers. We have our cash sales, plus all the credit sales that we collect for the month, and in January, we collect 113,850. In February, 125,750, and in March, 127,650. And we've accomplished our goal here. Of course, we could add these three numbers up if we wanted to say, well, what's first quarter cash receipts? Okay, and so here's our cash sales, which we collect in the same month, and then the credit sales, you have to, it's a multi-step calculation. You have to go back previous couple of months because our collection history, and again, I'll give you this, says that some of the credit sales we collect this month, some we collect in the following month, and some we collect 2 months later, and then 2% goes bad on us. Okay? And so you should be able to reconstruct these numbers on your own. This is the first half of the cash budget. The other half, which I'm not going to do on the board, would be a cash disbursements budget, but it's going to be comparable. Now, a couple of quick comments. If I knew I was going to sell an old piece of equipment, I would estimate how much cash I was going to receive, and I would add a line item saying sale of equipment. If I'm going to receive a cash dividend from an investment, I would add it in there. So any other cash receipts that you're aware of, you would put it in the cash budget. This is simply our cash receipts from sales revenue, but you could put in other collections as well. All right? Cash disbursements would be how you pay your bills. If you're going to buy a new vehicle, pay cash, or a computer, and you know when you're going to do it, or you can plan. You can look at your receipts and disbursements and say, I think I better wait a month or two before I spend that thing, and you're going to pay all cash, for example. You'd build it into your disbursements budget. And your bills, you may pay 50% this month, 50% next month, or however a company decides to lay it out. So the construction of the disbursements budget would be similar in format to your cash receipts budget. Okay? And then you compare cash coming in with cash going out. Of course, you're going to have a beginning cash balance, whatever cash you have in the bank, plus cash receipts, minus cash disbursements, will show you if there's any leftover cash, and if there is leftover cash, is it a sufficient amount? Most companies say we want to have at least, say, $10,000 cash in the bank, just in case there's anything unanticipated. Should we fall below that, then I would go to my line of credit with the bank and I would borrow whatever I needed to get to 10,000. And of course, then I'd pay interest on that. And of course, if I'm going to run short, at least I can see in advance that I'm going to need to tap the line of credit so I can pay my bills and restock the shelves. Okay? So all these budgets collectively get put together in a master budget, and from all the various budgets we construct a budgeted income statement and a budgeted balance sheet. I'm not going to ask you to do those. I could ask you to do the cash receipts budget, and then collectively this is the starting point. This is all in the planning stage of how a company anticipates how the following year is going to roll out on a month-by-month basis. It allows them to do some advanced planning, to make some adjustments if they anticipate, if they can see that there's going to be any shortfalls, they can plan ahead. Very important process.